Welcome to the ROI podcast. My name is Ryan Isakainen, ETF strategist here at First Trust. Our goal for this podcast is to discuss some of the questions that financial advisors and their clients have in a very sometimes confusing market environment. Fortunately, I have some of the best resources here at First Trust to have conversations with to discuss some of these topics. And my guest today is Bob Carey, Chief Market Strategist here at First Trust. So Bob, welcome to the podcast.
Great to be with you, Ryan. I love the name of your podcast, the ROI podcast.
Well, it's got many layers of meaning.
Absolutely.
So to start things off, you've been at First Trust for how long?
32 years.
32 years.
Yep.
And how in the world did you end up here 32 years ago?
Well, basically, at the very, very beginning of our firm, there was an opening in the research department. And I applied, and eventually we made it happen in the more or less the fall of 1991. So here we are, 32 years later.
That's amazing. You spend quite a bit of your time traveling around the country, talking with investment professionals, and you kind of get feedback on what you're talking about. And I want to start there. When you talk to advisors around the country this year, so we're a little past midway through 2023, what is the most common question that you're getting today?
Great question. I would say that I think a lot of people are just very surprised that the market is up this year and up as much as it is. And I think everybody knows that the market has been driven largely by a handful of stocks. So it kind of begs the question, what's driving those stocks?
Right.
And I think a couple things have happened, but I would say that's probably the biggest question that I'm getting right now is, why is the market up this year?
Yeah.
We clearly see an economy that is doing okay. Inflation is coming down, which I think has been helpful. The employment situation is still solid at this point, but we've got the Fed raising interest rates aggressively. And normally, when the Fed raises rates, you do eventually see the market roll over. We have a recession, we see valuations come down, and we're all kind of waiting for the next shoe to drop with all this Fed tightening going on. So I can understand why people are apprehensive and kind of wondering, well, why is the market up this year? But I think it's pretty simple. I think ultimately, I think two things happened at the beginning of the year. One of them bad. Obviously, we saw several rather high-profile financial institutions get in trouble.
Right.
And what's kind of interesting about both of the major institutions that failed was that they bought too many treasuries back in 2020 and 21 when yields were really, really low. And then obviously, interest rates went up and the value of those investments went down. I've never seen a bank fail because they bought too many treasuries.
Right.
I mean, it's just kind of talk about a sign of the times, but it kind of tells you how low interest rates were a couple of years ago. But the other thing that happened is all of a sudden everybody got this Chat GPT thing. Everywhere I went, everybody's like, "Hey, have you messed around with Chat GPT?"
Right.
It was like, and all of a sudden this fascination with machine learning and artificial intelligence, if you want to call it that. I mean, there's all these different things that really got people very excited about, the companies that might be involved in this. And there's no question. We all can kind of see this as the future to some extent, but I think that really drove the market quite significantly. This reminds me a lot of the late 90s. We got the internet, we got mobile phones, we could see the world was changing, and a lot of good things that might happen 4, 5, 10, 20 years down the road, it gets pulled forward and valuations go up.
And sometimes it overshoots like it did at the dot-com bubble. A lot of ideas were pulled forward too much.
No question.
Are we at a similar state now, or where do you think we are with respect to that hype cycle?
We might be. There's valuations are definitely very high for a handful of companies that are kind of the higher profile companies that we're talking about. I mean, a lot of these stocks were beaten up last year too.
Right.
So they did get a bit of a kind of a correction, if you will, last year. And it could very well be that maybe they were due for a little bit of a rebound. Maybe the correction went a little too far for some of these companies. I think that might be part of it. But the other thing that's happened this year is we have seen inflation come down. Mm-hmm. And stocks are very sensitive from a valuation perspective to obviously at interest rates, but really to inflation rates. That's a big part of it. So the inflation rate coming down, I think, has probably driven down the discount rate for companies to some extent. I think that's been helpful, and I think that's been really helping valuations for the market this year.
Yeah. So are there any particular areas, you brought up ChatGPT and AI, and there's a lot of uncertainty about how that's going to play out, but when you think about broad industries and sectors, are there any that intersect with that you think will be better off 5 years down the road, even more near term than that?
Yeah, I'd say probably the semiconductor industry. I think obviously software comes to mind. I think there's going to be a lot of applications that will improve efficiencies in a variety of industries. There's no question about it. But we always kind of wonder. The semiconductor industry has grown a lot over the years, but there's always these cycles, right? And we always kind of wonder. We have a down cycle, and we kind of wonder, well, what's going to be the next big thing that will drive the need for more bandwidth, more information, more data to be shared ultimately. And I think we may have found that with AI and machine learning. This has all been brewing for a long time, but it's something that the public now has something they can mess around with, and they can see it. And it's been going on for a long time. But a lot of things that we use, we don't realize it, but these machines are learning a lot of things about what we're doing. But I think it's much more tangible now, and I think that's where the excitement comes in.
So there's a lot of building happening with semiconductor foundries and factories, and it seems like all over the country that's happening. And that takes a little while to play out, doesn't it?
Yeah, the cycle's very long.
Yeah.
To build a facility that produces semiconductors, it's not something that you just break ground and you start producing chips next year.
Yeah.
It is as quick as maybe 3 years to as long as 10 years before these things actually finish getting built. I was just in Ohio a couple of months ago, and I could see where some of these facilities are being built, and you just vast amounts of land and these enormous slabs of concrete, if you will, to kind of stabilize. It's a long process, and these plants, a lot of things have to be done and done precisely before they ever produce a chip. So we're talking about billions of dollars in investments, and whether or not those investments pay off really depends on whether or not demand is there for these chips down the road. So it's not without some risk,
right?
And the market's always trying to gauge those risks. And last year we could see there was a slowdown in the tech sector, a bit of a hangover from the work from home, everybody getting equipped to work from home. You could really see tech spending was down. And this year, it looks like things have maybe stabilized a little bit in that space. And now we've got something to think about for the next several years that has the market excited. But some of these companies that are in the semiconductor industry that have gone up a lot this year don't even own any plants. They design these chips,
right, and
they rely very heavily on plants being built around the world that might not come online, some of them, for many years. So
yeah.
it's a development. It's exciting, but it's not without risk. And last year the market was very aware of these risks. I mean, we saw some of these stocks get cut in half. This year, some of these stocks are up 100% or more, some of them. So it's not for the faint of heart, for sure.
So I think of semiconductors and some of the stimulus acts that have been passed, the CHIPS Act, and the way that is framed is that this is a geopolitical issue, and we need to have manufacturing reshored in the U.S. Do you think that's having any impact now, or is this something that is not as relevant?
Yeah, I would say the jury's out. We've never really had anything resembling an industrial policy in this country. A lot of countries have industrial policies, kind of favored industries that get more or less coddled. Well, sometimes those industries become less competitive when they have a lot of government assistance, and so the free market person inside of me is skeptical that this is having any impact at all. I think it's natural if you're running a business that relies on outsourcing and your supplies are coming from parts of the world where you might not be able to get access. It makes sense that you would want to maybe onshore some of that. I think onshoring has been going on anyways, and I think Congress knew. I think a lot of people realize the importance of onshoring, and I think Congress wanted to get involved and take some credit for it. In a way, that's how it is.
So when you think about investing from a U.S. versus international perspective, especially at the point that we're at today, midway through 2023, do you have any thoughts on where investors should be looking from an allocation perspective? Should they be tilting more towards international than they have in the last few years, or should they stay in the domestic side of things?
I think near term, I would say that maybe international will keep up and maybe even outperform a little bit over the next year. When I look at earnings estimates for the rest of the year, I look at estimates for next year, I would say the trend is probably a little bit better for overseas markets than they are for the S&P 500 domestically. However, for the last 10, 11, 12, 13 years, it has been the U.S. market, really has been the place to be, especially the S&P 500. And the reason for that is not normally the currency plays a huge role in that. If you want to invest overseas, you expect those stocks to outperform overseas. Typically the dollar weakens when that happens and the dollar goes up. You want to be in U.S. stocks. Normally that's the relationship. But in the last 7 or 8 years or so, the dollar is pretty much been range bound. Yes, it did surge last year, but it's come back down. The dollar is not the swing factor anymore like it used to be. What's happened is U.S. companies, the S&P 500 companies, have a significantly higher, getting back to your podcast term, ROI, return on investment for U.S. companies today. Looking at the S&P, they are much, much higher producing cash flow machines ultimately than companies overseas. So many companies that have really come on the scene here in the last 5, 10, 15, 20 years. For the most part, those companies that are very, very high return, high growth businesses are based here in the U.S. They're very multinational typically. They do business everywhere. But those companies happen to be based here in the United States for the most part.
Why is that? Is that from education or regulatory standpoint? Like what causes that?
I think it's just technology. I really do think the internet age, just going back to the 90s, the age of the internet and information technology and all the technologies that we enjoy, it really is a global phenomenon. But for the most part, the companies that have really figured out how to make more with less, which is really what entrepreneurs do. It's the U.S. We are the most entrepreneurial country in the world, and you could argue that maybe we kind of lost our way for a while back, maybe in the 60s and 70s. But I would say in this day and age, it's pretty obvious that we have much, much better businesses, and we have a better environment for creating these kinds of companies. You think about all the companies in biotechnology and semiconductors and software. For the most part, the leading companies, even automotive manufacturing today. I mean, the leading kind of company in that industry over the last couple of years is Tesla, and Tesla is based here in the U.S. Yes, they do business all over the world, but there's really no equivalent. A lot of companies that want to compete with Tesla that might be based in Germany or China or Japan, but nobody's been able to figure out how to make vehicles and make them as profitably as a company like Tesla. But we see that again and again, these companies really emerging from the U.S. Just to put some numbers to it, I calculate that the ROI for the S&P 500 this year at the balance sheet level is nearly 3.5 percentage points higher than it is for most developed countries around the world. So we just simply have higher cash flow generating companies that dominate our market.
So why don't technology companies blossom in other countries? Like what is it about the U.S. that causes these companies to be located here? Tesla, you mentioned, all these, they can locate other places. Why do they locate here?
Well, you need capital and you need people to make things happen. And you look at the list of the top engineering and science and STEM related programs around the world, universities and whatnot. boy, we heavily dominate that list. You look at the top, say, 100 engineering schools in the world. I mean, half those universities are based here in the United States. So I think we've always had this technology-driven economy, but I think especially now, in this day and age, with all these new industries that have been created, it just kind of feeds on it.
It's like a virtuous cycle.
That's what it is, exactly.
Yeah. Well, that is probably good news for us, and hopefully that virtuous cycle continues despite efforts to disrupt from
I
time
mean,
to
you
time.
think about it, you run a business, you need capital, and we have obviously enormous amounts of capital,
Right.
and you need knowledge, and you also need at the same time you need private property protection. You need intellectual property protection. We tend to do a much better job of protecting intellectual capital in the U.S. compared to many other places.
Yeah. Okay, another broad question for you. What do you think is the biggest misconception that investors have or investment professionals have as they're thinking about how to allocate capital? Where we are today, we've had this surprising surge in market in equity markets this year. Is there any misconception that you come across that you think this would be a good thing to discuss?
Yeah, I think one thing that I keep mentioning in my comments and my presentations that seems to be getting some traction. I'm trying to get people to think about things more from a longer term perspective. Obviously, there's a lot of focus on markets short term. I mean, I'm reading the newspaper this morning online, and they're talking about a lot of things that might happen this week. We got all these reports coming out. We've got earnings coming out, and it's important to focus on that. Maybe to some extent, it's very easy to lose sight of the long term, and I think that is. I've been thinking about this a lot lately. Obviously a lot of folks getting older. A lot of baby boomers are well into their retirement years already. A lot of them are about to retire. At the same time, I've been going to birthday parties here lately and buying birthday cards. And at the bottom of the shelf, there are birthday cards for people turning 100 today. I'm pretty sure that market didn't exist not that many years ago. I mean, the idea of living to be 100 years old was you didn't think about that. So, for somebody that's in their 60s or 70s, obviously we never know how long any of us is going to be around, but the need to think about the potential to be alive in well into your 80s, 90s, even 100. I think it's you got that going on, and of course we've got these elevated levels of inflation over the last couple of years. So it really kind of I think forces us to think about the long term, knowing that hey, the market near term, a lot of things can happen, but we know that from a long term perspective that it's investors that win, and a lot of folks are buying T-bills thinking they're making investments. I'm like, you're not really making an investment. You're, hopefully earning a decent rate of return, enough to offset inflation. But we all know that those rates can be very short-lived, and they're probably not going to live up to where the inflation rate's going to go over the long term, especially after taxes.
Right. So if that's the case, and I think that's a really interesting point, that people are living longer, and when it comes to there's certain rules of thumb that we all learned early on, that you take your age and that should be your allocation to bonds, and it kind of grows over time. Does that change the math?
I think for some people it might. I really do. I really do. I think I think for a lot of people, I started my career, just to back up a little bit. I started my career in the 80s, and I saw a lot of people retiring and selling literally all of their equities.
Yeah.
And saying, hey, at this point, I just want some income. If I can earn 6, 7, 8, 9% on my bonds, if you will, my fixed income, my CDs, whatever people were buying back then, you could argue that that kind of made sense because inflation was coming down and the rates of return were real. I mean, you actually had a spread between the inflation rate and what you earned on your interest. That spread's very thin right now. I mean, it's gotten a little bit better as the Fed has increased rates this year, but the reality is that transition to being maybe a little bit more cautious, having more safe assets, I think that transition for a lot of people, probably should be pushed out further into the future. I mean, everybody's situation is unique, and I think
Sure.
that's the art of being a financial advisor, a financial planner, is knowing your client and their circumstances.
Right.
And for some people, maybe they can't have a lot of risk in their portfolio, but I think to the extent that you can plan for the next 10, 15, 20, 30 years down the road, I think it's important to
Right.
just to be open to that idea.
Yeah, if someone's retiring at 65 and living to 75, that's 10 years. If they're retiring at 65 and planning to live, 85, 95, it's
Look,
a whole lot of...
on a personal note, my grandmother's sister died last year at 105. I mean, my grandmother died in 1976, just to give you some perspective, and she was, at that point in her 60s. The idea that her younger sister would be alive in 2022, it's like, it just kind of blows your mind. So you never know.
That's remarkable. 105.
105.
Wow.
Amazing.
So that makes me think of the healthcare sector.
Right.
And that's an area that I know, you have talked about a lot over the years,
Yep.
biotechnology, healthcare, some of the things that are happening in that sector. Do you have any thoughts on, just broadly speaking, the healthcare sector or biotech specifically?
Yes, we have been watching very closely the number of products that are in clinical trials. I think that's a very important thing to keep a handle on when it comes to pharmaceutical companies, biotechnology companies. These companies can't just come up with something and sell it in the marketplace. They have to prove that these products are safe, effective, all those different things. So the number of different products, that number keeps climbing. You can really see the investments are being made in R&D and clinical trials. At the same time, we have been in a bit of a moratorium on mergers between maybe bigger companies in the biotech space, for example, or maybe companies in the pharmaceutical space that want to maybe broaden their pipeline or have more products. That's always a challenge if you're running a company in the pharma sector, in biotechnology, is you need new products that have patent protection, that have something novel, something new, that can create some shareholder value. So the race is on to gain control of these products down the road. And in the past, there'd always be mergers, a lot of activity. One of the reasons you might buy, for example, shares of a biotechnology company is the prospect that it might be taken over one day. We have really seen a moratorium on that the last couple of years. The current occupant of the White House, his administration is very hostile to mergers in general.
Yeah.
And I think the market is kind of waiting to see, where the next big deal might happen. And we have had some deals happen here lately, and we've started to see maybe a bit of a thaw. Market forces are naturally going to give us this result, but we've got a pretty heavy hand from the government right now holding some of this back.
Yeah, that is interesting because that the usual state of biotech companies is they have trouble having the capital to make it through phase 3 trials.
That's right.
And so having a larger, better funded biotech or pharmaceutical company can come in handy and kind of going through those.
No question. Yeah, the concern that I have, without the risk capital necessary to make these investments, to get these products to marketplace, we could very well see a drought at some point in new products. And at the same time, we've got people living longer, and the longer you are alive, the more likely you are going to have something happen to you. So so you can't help but wonder if in fact we are going to see the future like we maybe thought a couple of years ago. We'll see if this plays out. I have faith in technology and eventually policies heading in the right direction. But I think it's pretty fair to say that there has been a little bit of a political cloud over the pharmaceutical and biotech sector the last couple of years. And it's left the stocks, I would say, reasonably priced compared to a lot of other areas of the marketplace.
Right. Another area, Bob, that I have been getting questions on, and I'm sure you have as well, is when you look at the structure of equities, what has performed well versus not as well this year, it is heavily favored large cap stocks, especially some of the companies that we were referring
Yep.
to before that are related to AI and have gotten a boost from some of those technology multiple expansion. But I guess my question is, why is it there's been such a trend over the last decade where small and mid-sized companies, their stock valuations have gotten a lot cheaper relative to large cap stocks? Do you have any thoughts on why that is taking place, and is it going to continue, or is this going to reverse at some point?
At some point, I do think it will reverse itself. When you look at the outlook for earnings growth over the next 2 years, small and mid-cap indexes actually have a better earnings outlook than, say, the S&P 500. So I think the market eventually will recognize that. I think the market recognized that last year. We actually did see mid-caps especially do relatively well last year. And I think through the first couple of months of the year, we saw the same thing. But then we had these bank failures, then we had this massive flight to safety, right? One of the things I've been watching very closely for a long time is the difference in returns between the S&P 100 index, the OEX index. If you look at that year to date versus the S&P 500, that gap is enormous. And normally those two indexes sit right on top of each other over you go back, over the decades, very, very little difference in returns between 100 and the 500. This year, the 100 is outperforming by the most it's outperformed the 500 since 1999. And you think about what was going on in 1999, same sort of thing, a lot of excitement about technology. So to some extent, I feel like we're reliving the late 90s to some extent. The one difference I think is that returns on capital are substantially higher today. Most of these companies that are doing well in the stock market, for the most part, are companies that have got a lot of cash on hand. They've got proven business models. They generate a lot of cash. So the upward swing in valuations that's driven the S&P 500 this year, it really is because of a handful of stocks. I do think that the improvements in returns on capital have been significantly higher for larger companies than they have been for smaller companies. So, you think about some of these big technology companies, you just don't find these types of companies to the same extent in some of these small cap indexes. So it might be that we need a correction, or maybe a stiff correction, or even a substantial pullback in the tech sector for the market to begin to broaden out, which is exactly what happened back in the early 2000s.
Looking at returns from 2000, 2001, 2002, you really did have some pretty decent performance in those mid and small cap.
Yeah, as long as you didn't speculate on the dot-com stocks that melted down, and the tech stocks actually did pretty well during that environment. I mean, it was, banks did well, the energy stocks, and things that nobody wanted to buy in 1998, 99 actually turned out to be pretty good investments over the next 5 years.
Okay, final question. Energy. The energy sector has been really confusing for a lot of investors over the last couple of years. Went from COVID, where energy stocks were rock bottom valuations because there was so much uncertainty, to a point where they surged last year. This year they've got reined in again. How should we think about energy stocks?
Well, the reality is that the energy sector is very diversified. There's a lot of different companies that do different things. But the backdrop of lower oil and gas prices, natural gas prices being as low as they are, oil prices coming down, it's not a good environment for investors to want to take on a lot of risk in that particular sector. You've got producers cutting back production, which in the end should eventually lift prices. But it's amazing how cheap some of these stocks are. A lot of these stocks at 6, 7, 8 times earnings. The problem is that earnings for the rest of the year and the next year, those earnings estimates have been coming down. So you've got this massive headwind of earnings expectations going down from a near-term perspective. It's still an important sector, and we can't do really anything without energy. But investors, just whenever a sector rolls over and the profitability begins to come down, and you've got returns on capital that are, going down at a time when there's excitement about other sectors, you can really see the market preferring those companies where returns are higher, maybe headed higher.
Mm-hmm. So if investments are not we don't have incentives to make investments over the long term, doesn't that mean that we're going to have less production and therefore likely higher prices for oil and gas?
Quite possibly, yeah.
Which could be good for the earnings of those companies. I would think.
I had an economics professor that said the cure for high prices is high prices, and the cure for low prices is low prices. Eventually,
Free markets are amazing, aren't they?
Exactly. And at some point, you would think if investment is low and production goes down, at some point you're going to see some pricing power getting restored. But it doesn't look like it's going to happen this year.
Yeah. All right, Bob. Well, thank you for having this conversation. Thanks for all the wisdom, and thank you for all the financial professionals and investors that may have joined us today. Again, I'm Ryan Isakainen, and this was the ROI Podcast.